Welcome back, everyone, to the Financial Thought Exchange podcast, where you get a bit wiser by learning from the leading thinkers in finance. I'm your host, Laura Moberg, and today I actually have two guests. Steve Sexauer is the investment officer of the San Diego County Pension Fund, where he oversees the fund's $17 billion pension trust fund, as well as its investment team and investment consultants. Larry Siegel, or Laurence Siegel, is the research director of the CFA Institute Research Foundation. He's also a seasoned investment management professional, specializing in investment policy and strategy, writing, and speaking. Welcome.
Thank you, Laura.
Thanks, Laura.
So great to have you both. And we have you both on because you've written an article together. It's been published in the FAJ, the Financial Analyst Journal, in the fall of 2023. And it's called the Harry Markowitz and the Philosopher's Stone is the full title of that. So I thought for our audience, maybe you can start by just giving an overview of what the motivation is behind the article, why did you write it, and just an overview on what it covers.
Well, Harry Markowitz literally founded the field of modern finance in 1952 with his explanation of how to construct an optimal portfolio of securities. And all of investment finance and most of the rest of finance follows directly from that discovery over 70 years ago. He also was a great mentor to other people who, like Bill Sharp and Bob Merton, Jack Trainer, who created the rest of the field of finance. And when he passed away, he left behind a legacy that really doesn't compare to any of the other great finance scholars of the time, because he was a philosopher as well as a finance geek, and he imbued his work with a kind of general knowledge of the world that sometimes is missing from the things that we do here in our field. He got the Nobel Prize in 1990, the first one, finance, which was shared with William Sharp and a third winner. Forgive me for not remembering who it was. And since that time, he's kind of been a father figure to the industry. When he died, everybody was very saddened and also inspired to write memorial pieces, and that's what Steve and I did. We called it Harry Markowitz and the Philosopher's Stone because there was an obscure book written in England earlier in the century called Harry Potter and the Philosopher's Stone, and we thought that there were some things in common between the two. Steve, do you want to elaborate on that?
I'd say that's it. One sentence I'd add is a lot of investing is judgment, and you have to think about what's happening. Theory matters as much or more than evidence, and so anchoring on the fact that Harry was truly a philosopher in his heart and in his work, I think is a great frame of reference for all of us that toil away in the markets and all those who are joining us in the next generations.
So many of our audience might have seen his name a lot when studying what's called modern portfolio theory. And people who are new to finance or old in finance will remember the many hours or going through this frontier where the whole idea of like this trade-off between risk and reward. You show that the trade-off between that, and you show this efficient portfolios that he suggested you could plot out. So that's maybe what people know about Markowitz. That's the Markowitz for everybody who were thinking, what is this Markowitz we're talking about? That's Harry Markowitz, who came up with that. Maybe we should also give a little bit more background of who he was as a person. Where did he come from? It was mentioned he was a philosopher of sort, but also in finance. Was his background in finance at the beginning, or how did he become such an important person in financial theory?
So I'll take an initial crack at that, Lada. He was from the south side of Chicago and a brilliant mind. He ended up going to the University of Chicago to study mathematics. And mathematics back then was in its kind of renaissance, if you will, of doing things in an everyday world. And that's where he lived. And he lived with some of the smartest mathematicians there were, along with the crowd at Princeton and other places. And by accident, by his telling, he was in the economics department as a graduate student now, trying to get a PhD. His advisor was Milton Friedman. Outside Milton's office, he runs into a stockbroker. He said, well, you should work on markets and risk and return. And now, frame of reference, the Cowles Commission had been at Chicago, and these were all European engineers and mathematicians doing the work. So this wasn't like a strange thing to have smart math people working on financial and economics problems. And, by his telling, he said, how would I match risk and return? And he set off on a problem-solving expedition that, as Larry said, has been the foundation of all investing since then around the world. This was built upon by Bill Sharp and CAPM, and then all the giants that followed him. So we labeled his insight a bolt from the blue, much like John Napier's invention of or use of logarithms in 1614. Never before had anybody seen it, and after that, everybody used it from then on, and it changed the world. So that was Harry.
Fascinating. And what decades roughly are we talking about? You mentioned that he studied under Milton Friedman, so that we're going back a few decades here.
We're back in the 50s. Was the paper. Talking about the late 40s, early 50s. And for the people in the business that might listen to this, all the engineers and mathematicians aren't going to be, this is going to be nothing new to them of the work that was done at the universities and at the Rand Corporation during and post-World War II. It really was a renaissance of applied mathematics. And Harry just happened to have the insight to apply it to investing, where he said, to get returns, you got to take risk, but how do I allocate? How do I measure? And how do I, importantly, make the trade-off between risk and return?
And one thing that might be, that's fascinating. And one thing that might be important to note here is when people study finance today, before the second day, maybe in class, you'll come across the CAPM, the capital asset pricing model, and where it's all about finding this one portfolio that is the best for everyone. That is not Markowitz, right? He comes up with a frontier where many portfolios can actually be the efficient portfolio, so to speak. How do we understand that?
Well, the way you framed it, you made me pause that he didn't come up with the portfolio. Let's work backwards, because I think it sheds.
You can definitely correct me on that one, how you would say that.
No, I'm correcting you. In the paper, we talked about he triggered the giants that took the concept, the bolt from the blue, and really developed it into a serious theory, a lot of empirical work on how to prudently and intelligently trade off risk and return. So exactly what you said, his specification said, in lay terms, for this level of risk, this is the most efficient portfolio you can build. And so you can go from very low to high. And so that's the famous Markowitz efficient frontier. And its shape is defined by the correlations between the securities and the variances. And Bill Sharp had like the second bolt from blue. Wait a minute. One of these is the best you can be. When you're talking about trading off risk and return, to a mathematician, that's an optimization problem, or I maximize this subject to that. Bill Sharp and Harry Markowitz are both at the Rand Corporation, where all this applied mathematics was being done. And he said, what if I just pick the best portfolio, the most efficient portfolio, and I connect that to the risk-free rate? I can be anywhere on that line, right? Depending on how much from the tangency point down to zero risk. And that line is well above any efficient portfolio that was on the Markowitz frontier. And then they said, well, how do you go past that? And he said, well, you use leverage. Implementation problem issue there, but So that was Bill Sharp's just stunningly brilliant insight.
So he still said one more thing, which was that best portfolio is the market cap weighted portfolio of all risky assets. So the market does the optimization for you, and you don't have to make any of the calculations that are in the Markowitz formula.
And that insight still persists today. It's buried in our triangle where you say, hey, if the market portfolio is the best estimate of the most efficient way of the future, and it's the most efficient way to allocate your resources, start there. And then you've got to make a case to yourself, your own judgments, why you can do better.
Yeah, so since you mentioned that, we can jump into that. When you say triangle, so there are three corners of a triangle here. Right?
Yes.
So one is the market portfolio. Which are the other two?
Larry, you want to tackle that?
Sure, but I want to preface it with the thought that this is not a triangle that's in the finance textbooks or even anywhere in the literature. We made it up, inspired by the need to say something about Harry that went beyond saying what a nice man he was, how brilliant he was. We thought we should make an original, although my contribution to the field. And what we said was that if you're an investor, you already have some sort of portfolio. And then there's a world market wealth portfolio, which is the hypothetical best portfolio that exists of all the assets in the world. And then there's a third portfolio, which is whatever your team of experts, if you're a pension fund or your team of advisors, if you're a retail investor, is telling you to hold. So the correct solution for you, there's no one correct solution, but the beginning of the correct solution is somewhere in that triangle. And so typically the portfolio you hold is full of legacy positions, things you're holding to defend a tax position or because you inherited them. If you're an institutional investor, because you've got a donation from somebody, a company stock back in the 80s. So it could be a mishmash of just about anything. The portfolio your experts are telling you to hold is based on that group of people's forecasts for what is going to happen in the markets for, say, the next 3 to 10 years. Maybe if they're good experts, if they're lousy experts on it, so over the next year or two. And then the world market wealth portfolio itself, which is, by the way, somewhat difficult to estimate, because when you get beyond the stock market and the bond market, other assets like real estate or human capital, you really have no idea what's in that portfolio, so you have to make guesses. So, Steve, how do you put together these three portfolios to come up with? You have to wind up with one in order to make a decision and hold it. How do you combine them?
So Larry's question on how to combine them, I'm going to put a preamble sentence. Well, Larry said we just kind of made it up.
Just to clarify here, Steve, I'm sorry, before you continue. So I just need to summarize, because Larry said a lot of things. That's the three portfolios that you're talking about here, right? Is the market-weighted portfolio, the market cap portfolio. That is what everybody in the world is invested in already. The other one is a portfolio that you would listen to some kind of group of experts saying this should be the better portfolio. And the third one would be theoretically derived from really the CAPM framework.
Well, no, the third portfolio in the triangle. If you haven't read the article, for those of you in the audience who haven't read the Financial Analyst Journal article, we draw the triangle at the vertices of the triangle are the world market, the experts, and whatever you're starting with at this moment. Mm. And then the goal is a fourth portfolio, which is somewhere inside the triangle.
Thank you. Go ahead, Steve.
So our motivation here was the pieces in this triangle all exist, and they've all been really thoughtfully done. So taking the weights of the market portfolio and computing the expected returns, Black Litterman, Bob Litterman, they did a lot of work on what's the general equilibrium solution based on what's going on in the market. And so I think the way to think about it this way, I think I see a triangle behind you of lines on the screen, so it's easy to describe this. So why do you get up in the morning and you're the CIO of a large pension fund, and at the end of the day, you have to determine what the asset allocation is, which will determine 90+% of your returns. And so the question becomes, what weights do I give to each asset class? That's your job when you get up in the morning, right? And you could say, I'm going to let my expert tell me. Whatever my consultant tells me to do, I'm going to do. Okay. Or you could say, I have no clue. So I'm just going to take the cap-weighted indexes, whenever, let's just say I'm just doing stocks. Wherever the market is, I'm going to own that. I'm going to index it. I'm going to go to one of the great index providers. So you could do those two things. Plus you've got, as Larry said, well, you're already sitting on a portfolio, right? So now you're looking at some way to trade off those three portfolios, right? And what the core of modern portfolio theory, Harry Markowitz, is, well, we should have a systematic way to do that. We should see how much expected risk is in each portfolio, and we should know what the expected returns are. And so what happened in practice with some brilliant minds is they said, oh, this is good. If you tell me the weights of your portfolio, here's the cap-weighted market weights, I can tell you what your expected returns are for each asset class. I just do Harry Markowitz backwards. In fact, anybody in this call with a spreadsheet with the market caps of the index can do it themselves. So now I know what the expected risk and return is of the market. Then my consultant says, no, we've got these experts. We know how to forecast the market. We have this model. Here's the weights you should use. I'm like, well, these are different than the market weights. But then I take their weights. I do the reverse Harry Markowitz, and I go, okay, now I got the expected risk and return of his recommendation. And then third, well, wait a minute. I woke up this morning with a portfolio. What's that look like? I can see the asset allocation, but I want to translate it into, forgive the looseness of the terms, into Markowitz terms or into modern portfolio terms. What's the expected risk and expected return of my portfolio? And because I use the MVO calculation, and if I use a common set of numbers for the covariance, I now have comparable things. At the end of the day, I have to make a judgment. If I'm way away from the market for my allocations and my expected returns, I should be able to have an English language conversation with myself, my staff, my consultant, my board is, why are we doing this? And we playfully point out that in a paper Barton Waring wrote years ago, when you just take different client portfolios and do this, you get some real wild expected returns. And so it creates as always, the contribution we tried to make here, it gives everyday people that have basic finance skills a chance to compare different portfolio allocations with a common language that's based on really serious work by the best people, from Harry Markowitz to Bill Sharp to Black and Litterman and lots of others.
We also had a little fun with the naming the triangle. If you read the article, you'll see reference to the philosopher's triangle. Well, when Harry Potter looks at the philosopher's stone, there's no such thing as a philosopher's stone that translated into gold, which is the medieval holy grail of alchemy. Well, there's no real ideal portfolio either. But by applying this philosophy of investing, you have to come up with something. We thought that calling it the philosopher's triangle would be a nice homage to Harry.
Gotcha. So I would love to return and get a little bit more depth into what Steve was saying now. Also, what you described in here, in part, this backward kind of backward finding of returns and risk. That's very much the Black Litterman approach, right?
So, yes.
And that is where you see, oh, what are my weights? And implied from that, what would I be expecting returns and risks to be? And as you say, you go back and say, oh, well, is that really feasible? Do I really think that this is going to return 20% because I have such a big allocation? And if not, I should kind of scale it down.
Correct.
And Black Litterman, too, is known for removing extreme positions. And you kind of alluded to this, but maybe you can clarify kind of how that, what's the contribution on that end too of this model?
Do you want me to do that or do you want to do it?
I want you to do it.
So the Markowitz contribution and then the improvements in it, you want to think theory and you want to think, this is the way to think about this, and now I have a tool set to tackle it. There's a particular characteristic of when you run these optimization routines mathematically, you are 100% prisoner of whatever your inputs are. And an extreme input will take control of the iterations of the optimization, if you will, and pull you someplace because that number just happens to dominate all of the numbers, even if it's an unrealistic number. The second thing that the process, the actual engineering of implementing these ideas is, I can have an optimal portfolio. I mean, perfect, like MVO optimal, and I make a small change to all my inputs and my asset allocation completely gets reversed. I go from a 60-40 stock bond to a 40-60. So, you know, we live toiling away as practitioners, so we're trying to use the tools, and everybody knows this problem. We talk about Michaud's great contributions early on, but I mean, this has been around since the 80s. Philippe Jurian worked on it. And so everybody said, okay, how do we imprison and contain the mathematics of these extreme solutions? And so a lot of what you see is really engineering. Like, okay, I want to use this, but I don't want the calculations to go off into hyperspace. So I'm going to add these constraints, if you will. And everybody had a pretty artful way to do it. So in the hands of a really competent person, it's kind of like a pro pitcher knowing how to throw changeups. But if you're new to it or you're learning it, it can seem overwhelming. And our input is, you're missing the big picture. They've already figured this reverse engineering out. Yeah. They've figured out, make sure you're using this a robust, honest estimate of the variances and covariances, and it works. And then you can look at the results. And one of our themes has been, in this paper and others, is that theory matters as much as judgment or as much as data or more. And you've got to be able to make a theoretical and sound case. And that was the Black Litterman gift of, we want a general equilibrium solution that's consistent with the underlying economics of the economy. So, you know, if you look over long periods of time, the returns in stocks, the stock returns without dividends, really match nominal GDP growth and earnings growth. You can't do better than that. So, you know, Black Litterman's, we got to find a general equilibrium solution here if we're going to make prudent decisions. That was a brilliant insight.
And just a little personal note about Fisher Black. He famously said, "Don't confuse me with the data. I want to know if it works in theory, because if it doesn't work in theory, it doesn't work." He died 29 years ago, so he's starting to be forgotten, but he should never be forgotten.
And so people on the call that don't know who Fisher Black was, because you're in the current generation, in September and October of 1993, the FHA has an article by Fisher Black, very short and straightforward to read, called Estimating Expected Return. And I would read it. And basically he says, estimating risk is easy, estimating return is hard. But I would read it because that's the heart of this. You've got to make a judgment about an uncertain future. You need to understand the importance of theory and the importance of data.
Yeah, I would love to discuss a little bit more of that, because as we note here, it's a really tight and neat framework that Markowitz presented us with. it's not like he's served on the silver platter how to actually get the data that is crucial to get the model to somehow accurately represent what your portfolio should be on a forward-looking basis. You discussed a little bit of how you might measure these. Maybe one of you can just take a stab at giving an overview of different approaches that people have. Most people would just think, oh, just look at backward data, what happened in the past, and we'll plug it in, and most likely will be true in the future. But maybe you can give us a little more color, either one of you.
Well, the future equals past assumption is the most dangerous assumption you can make, but it's also the only place that you can get data for an optimizer input unless you have some special gift for forecasting. And so it's natural to just go back and see what happened. Stocks beat bonds, bonds beat cash. Japan beat some other country in the United States, beat Japan, and you put all of these historical results over the past 30 or 50 or 75 years into the optimizer, and it gives you a portfolio that would have worked perfectly over the last 50 or 75 years. Is that what you want to buy? Now you want to buy the portfolio that will work perfectly over the next period, and we don't know how to do that. So crafting optimizer inputs is an art, and you have to weigh your best forecast for the future, which may be from a dividend discount model or from bond yields if you're working on the bond market, or from rental income if you're working on the real estate market and so forth. Meld those forecasts with what you know happened in the past, because your forecasts could be out to lunch. I remember somebody put in 25% compound annual rate of return for frontier markets or emerging markets or something back in the 90s when they were growing up by about that much each year. And of course it didn't happen because it can't happen. Nothing can grow that fast for very long. And so you moderate it, or as economists say, shrink the estimates back towards some kind of historical, ground truth, which is that nothing can grow at those rates forever, nor is it going to shrink at those rates forever. That happens to be your forecast. And so people that put together optimizer inputs have to be merging art, science, a rich knowledge of history, and knowledge of the mathematics involved in all this adjustment.
So a lot of you had that sneakily difficult word in your question, how, which implies, well, gee, how would you do this? And so one layer below what Larry just said is, okay, so give me a practical example of how to do this. Mm-hmm. So I will. When you want to do this backwards optimization to see your expected risk and returns, the reverse optimization is going to give you the returns. So now you only got to worry about the weights. You can look those up or have your consultant tell you the percentages. So now you're down to one input you got to go get, and that's an estimate of the covariance of the assets. And so here's the simple prescription. Pick two reputable firms that do consulting. They all publish their estimates of the covariance of the returns. They typically give you the variances and the correlations. That's all you got to do. And then you run the triangle twice. One with company A's covariance, and one with company B. Remember, you're just looking at differences in trade-offs. You'll get expected returns, and you're kind of done. You don't have to. The basics, in that Fisher-Black paper, he says it too. Variances and covariance move, but they're fairly stable in the medium term. And all of the fancy pants mathematics of doing it a little bit differently, how you weight them or what the time window is, the market's kind of sorted that out. So as a practitioner, that's what I do. I just say, I tell our general consultant, give me yours, I get somebody else's. And then you're done. You don't have to, it's Larry and my favorite maven on how to do graphics for data, Edward Tufte, who's the king of visual data representation. He says, look, if somebody's done it well before, don't reinvent the wheel, use theirs. So
such
practitioners just use two experts and make sure that they're consistent. And there's just no way that, everyday people like Larry and I are going to go out do the math people that did their processes to do these things, and they give them away, which is the other nice thing.
So that means presumably that's conventional wisdom, which means that would already be embedded in the market cap.
It should be.
I don't think I understood that. Did you, Larry?
So if you look at experts that publish their covariance estimates, most likely that's where the average person of the market is going to get their covariance matrix, covariance inputs, which means that it's already embedded in the market cap.
Well, you have to differentiate between how robust the historical data is, and the reality is that the actual variance computation, which is a straightforward computation, is the same for everybody, covariance, and the co-movement of all these assets moves slow enough that that's not going to move the needle in your judgment too much. And if you're concerned about it, then ask, this is maybe too much for this call, but one of the things you can do is, like our general consultants, they publish every quarter their market forecast for their returns. That's their best judgment. But they also publish their calculation. It's a calculation of the trailing covariance in the assets in the market. Well, I could say, I'm going to go back and do my optimization comparison for the past every 5 years, and I'll use the covariance matrix they had then. And I can see if all of a sudden it moves on me. So you're in this trying to make an informed judgment with more information, but you have consistency. So the variance is just a calculation on the numbers. There's not a whole lot of forecasting that's going to make a difference.
Yeah, what I'm getting at is the notion of the expert view as opposed to what's actually inside information, so to speak. So if you want something that everybody's not already embedded in the price, you'll do that if you've been paying more than most big institutional shops would be paying for such data and such inputs. And if anything that is free out there, I'm going to assume that it's already embedded in the market price, which means that the market cap portfolio has reflected that already.
Oh, I see what you get. So think of it. Let's just do a practical example. I take the market, my portfolio, and the expert's portfolio today, and I look at the risk-return trade-offs embedded in them. And then, to Larry's point, I pick a window in time where the trailing correlations and volatility of the market are completely different, and I recompute the numbers. So I get two sets of market information that you would say everybody knows. There's no special insight here. The people who beat the market consistently, or portfolio management team, they have some insight looking at that data. Now they make a judgment. I'll give you a real life example today. Everybody knows that real estate, people piled into real estate in the free money era, basically 2009 to 2021 year end. And the way you get returns in real estate is you use leverage. You borrow and so now there's a lot of real estate out there that when the rates went from 25 to 525, the building's cash flow went from positive to negative, and it got worse. When you go to like refinance your loan, the bank goes, by the way, your building is only worth 80% of what it used to be, so we're only going to lend you 80% of the dollars that we lent you before. So we'll refinance your loan, but you got to write us a check for the difference. So if you have that insight, and meanwhile your consultant model and the market model, because there's a lot of real estate out there, is saying, the expected returns are really high in real estate, you're going to rerun the thing where you cut your real estate assets in half, and you'll say how much is, you'll start to make judgmental decisions that are theory-based and evidence-based, but the picture you're looking at is, as Larry said at the beginning, is inside that triangle. But you'll never find a special market insight here. This just tells you where, are you in the right football pitch and where. So those are very separable decisions. The expected return for equities in my allocation is 13% per year. You look at it and say, wait a minute, P's are 20, and the economy is not going to be growing that fast. That number just can't be right. And then you have to go through, this is the Fisher-Black argument, the theory as to why you're right and the market's wrong. So I think you separate any special insights from the whole modern portfolio theory gift that it's given us all for a structure.
Okay. Well, switching topics then, you discussed the fuzzy efficient frontier as another way of estimating the inputs, so the return, risk, and correlation estimate. That might be something that our viewers here have not heard about before. So maybe, Larry, do you want to give an insight about what this is about?
Well, the fuzzy frontier simply refers to the fact that you don't know how accurate your inputs are. And if you modify the inputs a little bit, you draw the frontier in a slightly different place. And if you continue to modify your inputs within realistic bounds to where you're capturing the full range of what might be a good input, you'll get a cloud as an efficient frontier instead of a line. But the cloud is the fuzzy frontier. Now, I would argue, I agree with this analysis, which is usually attributed to Richard Michaud, although they've had precursors, as Steve pointed out, Philippe Charillon, and there are others. All of those points in the cloud are statistically indistinguishable from each other. So unless you have a strong view of which inputs are the best and which are second best and third best and so forth, you cannot improve on the mean-variance efficiency or Markowitz efficiency of a portfolio that's in the cloud by going to another location in the cloud. And people have to weigh that fact against the transaction costs of moving from one place to another. So if your consultant tells you that you have, 13% in Asian equities, but based on my estimates, you should have 17. And then you look at how tiny the change in inputs was to get that change in holdings. You might want to look at that skeptically because it costs money to change your allocation from 13 to 17. And you're also probably adding to that particular asset at the time when it's gone up. So that's naturally how people raise their estimates and say, look at what just happened. So should we have had more of this? And And that adds a dimension of uncertainty to the whole concept of optimization, which was always there, but people don't always recognize it. They think it's science, and science provides precise answers. So you should buy exactly what's in the output on the spreadsheet. And I don't really agree with that because of the fuzzy nature of the frontier.
Well, it sounds like an approach for somebody who wants to be conservative with switching their portfolios, because there's always trading cost and other costs, just transaction costs in changing your position. So you want to know that it's not within your margin of error.
Exactly.
So that really makes
add
sense.
anything to that?
I think Lada framed it well. For the history here is good for the next generations. So Michaud, mathematician, Philippe Jorion, an engineer, they looked at the actual calculation in the Markowitz with the variances and the covariances, and they said, wait a minute, we don't know what the world's going to look like. These are point estimates, if you will, and they draw a line. That's not a line, it's a cloud. And we don't want people to be confused that there's these statistically equivalent portfolios out there, but they think one's better than the other. So that was their contribution. But one important thing, if you're a practitioner and you spend years in this business, every efficient, this is your optimal portfolio is presented with weights to 2 decimal points and a single line. And my guess is all the inside baseball people that do this know the Michaud-Jorion observation, but the other half are like, you got to be kidding me. And I'm very confident that 90% of the pension trustees would zoom out of the conversation after about 2 sentences. So I think part of the discussion here is to say, hey, there's uncertainty here, and this is the cloud is a good way to judge it. To your point, you're not going to make it. Why would you spend the expense of making a change to buy a statistically equivalent portfolio? You would.
Yes, that's nice. So jump forward then. CAPM, we mentioned before, is kind of this application of Markowitz, where if you combine it with a kind of a risk-free rate, there's supposed to be a risk-free asset out there that you combine it with. You can leverage it up, as Steve said. But ultimately, when it comes to the risky assets, everybody will hold a different portfolio, just more or less combined with a risk-free asset. Now, this model, when talking about all the data and inputs here, people have tested CAPM, and you can actually test it much easier in from what I understand from the literature than Markowitz. It's kind of hard to say that Markowitz is wrong in any way. There's been a lot of criticism of CAPM and that it doesn't really accurately reflect the data. And you touched on this a little bit, so it'll be fascinating to hear how you would introduce our viewers here on what the controversy is here.
Larry, I'm going to let you start because I'm going to look up the title of one of my favorite papers on this topic, because the title, it says it all.
I'm sorry, could you repeat the question?
Sure. So I was just asking about CAPM and the fact that there has been quite a criticism about the application of CAPM and whether it actually so-called works. So just thought you might want to cover a little bit of what we're talking about here.
Sure. The CAPM is a radical simplification of reality, which is what theories are supposed to do. And the CAPM says that the expected return on every asset in the world is equal to that asset's beta. I'll define beta in a few seconds, times the excess return of the market portfolio over the riskless rate. If you believe that, I have a brief in Brooklyn to sell you, and also some stocks that I way overpaid for that I'd like to also sell you. I think that the CAPM is an absolutely invaluable starting point, a point of departure for thinking about expected returns and risk. That doesn't make it literally true. And after the CAPM was discovered in the early 1960s, more than 1,000 papers were published, many more were written, trying to test the CAPM, see if it works on historical data, and the answer is it usually doesn't. The other factors turn out to be important, like size of the company, market cap. Small caps at that time seemed to have a higher return than large caps. Value stocks beat growth. There were some other more complex factors. There were international factors. And by the time that Eugene Fama and Kenneth French wrote their famous article overturning the CAPM in 1993, there were the concept of beta is dead was circulating in the investment community, but it's not dead. It came back, and the reason is that investors and researchers started to accept the basic philosophical proposition that a model isn't supposed to be exactly right. That's why it's called a model. A model airplane doesn't fly 240 passengers around, and a model of the stock market isn't the stock market. It has some sort of a core of truth that you have to keep your mind on while you're looking at more complicated things. So all these tests of the CAPM to see if it's exactly right, I regard it's kind of irrelevant, because the CAPM has to be correct at the macro level. If you have an asset with a beta of 1, which is the market, and an asset with a beta of 0, which is treasury bills, they're going to have a different expected return, and that's the CAPM.
What do you even mean when you say testing CAPM? I mean, if we look back, and CAPM is like a one-period model. It doesn't cut down into different periods and over time. So are we looking at the history as a whole and trying to do beta over the history? Or I think what people are doing is they're chopping it down to 5 or 10, or maybe even 1 year periods, and then look for what the correlations and all the data, kind of how that fits in over time into the CAPM.
So let me take credit at that, because I did find the title of the paper.
Sure.
It's an FHA paper. The title is Beta Dead Again? And it's by Richard Grenold, who is more competent than 99% of us to look at these things. And so it's exactly what you said, Lana, is the theory is, if I'm going to take risk, I want to be compensated. That's economic theory. It's utility theory. So when this concept was put forward, everybody said, oh, I can check that out. I've got all this market data, and I'm going to start checking it out. And then, and we do give a short history of when the data was first put in place, basically the CRISP tapes at the University of Chicago. So you have all of these talented thinkers and statistically hyper-capable people, and they said, well, I can test that. So they'd pick different time windows, they'd pick different countries, they'd pick different weighting schemes, and then they would run into, oh my God, there's no relationship between risk and return. It's like 0. How can this be? And then that led to this CAPM. I think what Larry said is really important, is from a general equilibrium standpoint in human behavior, there's going to be some mapping between risk and return. But I'm going to go back to the cloud for a moment. It's never going to be precise. When you push a button on an airplane engine, the engine turns. They actually know how fast the parts will expand, and it always works the same, short of a few things. If somebody forgets, metaphorically, to put bolts in. Human behavior is different, and humans behave differently at different times, but that doesn't dissolve the power of thinking CAPM. I give you an example. Real time, Bitcoin. Now, there's actually a paper out of the CFA Institute about how you would manage a portfolio with Bitcoin in it. Well, how am I going to estimate the variance of Bitcoin? The variance of Bitcoin is not on the same scale with any other asset we know of. In terms of, if I calculate its daily or monthly volatility. But at least I have a framework. I'm taking a lot more risk, so I better get a higher return. What's the theory? What should my correlation be between Bitcoin and real estate assets and U.S. equities? Personally, my know is 0. So if someone gives me here's Bitcoin and you should have Bitcoin to your trust fund, and they show me a correlation to equities of 0.7, I'm going to say, wait a minute, I know how to compute a correlation coefficient. The variance of that Bitcoin part of this thing is, if it's done right. So I have a theory, and I have a framework, as Larry said. Now when I go dive into the data, it's the Wild West. And the true gift of Gene Fama and Ken French and the others was they found a way to at least organize the data so that it was understandably robust, matching risk and return, the use of factor portfolios to deal with the size of a covariance matrix of 500 stocks. But you have a consistent way to think about things. And that's the power of it. The fact that I can have an intelligent conversation shortly here with you, this short time frame, and Larry, about Bitcoin is truly amazing. If you take away modern portfolio theory, how are we going to talk about Bitcoin? It's very powerful.
Has anybody ever... Go ahead, sorry.
I said it's very powerful, and then I said modern portfolio theory, not Bitcoin.
Yes, yes, okay. Always good to clarify. Has anybody proposed...
It has pays no dividends, and it cannot be redeemed for anything except more Bitcoin. So I don't think it has any value, but the market disagrees strongly with that.
So that's for the other podcast. Larry, we'll do that another time.
We should do a Bitcoin modern portfolio theory podcast. I'd like to listen to that.
We're planning it. Yeah, yes, absolutely. I'm joking, but we can talk about it.
You guys have a document that says here's how to do it. That'd be a great podcast.
Well, has anybody proposed any plausible proposal for replacing CAPM with all the people out there saying, it's not that good? And yeah, it's not that good, but as I think you make the case that it is still a model that is very useful and workable and can be used so many ways. Has there been any other suggestions out there that it's reasonably plausible for this could be a better application?
Absolutely.
Than CAPM?
Yeah, is when the small cap effect and the value effect were discovered in the late 70s, we started moving toward what's called the 3-factor model. And again, Fama and French wrote it up, so it's called the Fama and French 3-factor model, but it was being used way before that write-up. Then, so value, the market was the CAPM factor, then small in value, and then fellow Mark Carhart added momentum, and then it became a factor zoo. And by the time Campbell Harvey wrote this famous article called Factor Zoo, 400 factors have been identified. And at some point, you have more factors under our stocks. And so that started a movement to say maybe, well, these factors don't really exist, and each of them is a kind of a copy or a clone of a lot of the other factors. So there's kind of chaos in this approach right now. Nobody knows how many factors there are, and nobody really knows whether those factors are going to be usable in the future. And Steve, you might have a different view.
I'm gonna push back a little bit on Larry's first sentence that there are others. I'm gonna assert that they're all part of modern portfolio theory, CAPM. They're just specific engineering applications, and put on the table that the Markowitz insight of systematically matching risk and return and using the data and the applied mathematics that emerged out of World War II and the Rand Corporation is John Napier's logarithms. Ever since Napier came up with logarithms, we've done no better, and we use them all the time, and they're very powerful. In fact, I did a back-of-the-envelope calculation to see how fast NVIDIA's earnings would have to grow to get so that their market cap of 1.7 trillion would be a 20 PE. Well, I use logarithms to do it because it's the easiest way to resolve the. I mean, it's never going to go away. That's my assertion. It's so powerful. It'll be made better, but it's based on theory and general equilibrium and human behavior.
I agree with that, Steve. I don't regard it as a pushback. It's an enhancement and an explanation of what I said.
Awesome. Yeah, you agree. No, I mean, and it gets to your point, Stephen, in terms of financial system, just like the world as a whole it's a complex system, and that's why we get power laws, and hence logarithms are important. That's why the models don't work as an engine, as you say, not following the Newtonian physics anymore. Thank you so much for coming. I think our guests have been, and our audience have gotten a good sense of both Markowitz, the broad applications that his scholarship allowed for, and that there's a lot to learn. Even if you have heard about Markowitz before, that there's a lot there. And you should start, of course, by reading Larry's and Stephen's article. It's in the FAJ in the fall of last year. We'll post it to the show notes. And I'm sure you will all enjoy that reading. Also, make sure you read all the great pieces that are coming out from the Research Foundation. They all pass through the hands of Larry Siegel, so we know that they're all nicely put together and well written. So thank you so much, both gentlemen. And thank you, everyone, for thanks. And thanks for tuning in. This has been the Financial Thought Exchange podcast. I'm your host, Lara Moberg. Our guests have been Steve Sexauer and Larry Siegel, and we will see you again soon.
For more information, please visit rpc.cfainstitute.org/research-foundation.